Welcome to the Farms.com Risk Management Educational Grain Commodity Marketing School video series. This video series is being brought to you by DeKalb Brand Seeds to educate producers across Canada about grain commodity marketing. Well, in this 12th video series, we're going to look more closely at future contract obligations. We spoke briefly about this subject in last week's video. So today we're going to look more closely at broker fees. There's two types: broker fees, financial obligations, also known as margin. We're going to look at real life examples that you can follow, and then we're going to tell you how to choose that commodity broker and what role that commodity broker should play. So let's start off with those fees. There's two types. There's a brokerage fee, also known as a commission, and then there's also a margin or a bond requirement. The commission is the fee that the broker charges you in order for him or her to fill your order. If the commission is, in this example here, we're using $50, $25 to buy and $25 to sell, that entire commission of $50 is charged on the first transaction, because literally all trades are offset at the end of the day. Charging that commission for both transactions is known as round turn. That's the jargon they use on the Chicago Board of Trade or Chicago Mercantile Exchange. There can also be, when you get your monthly statements, there can also be, or individual contracts verifying the sale or purchase of a contract. There's also some small exchange fees as well. So now let's talk about the financial obligations or margin. Now, just for a second on those brokerage fees, when you're paying for more advice, the fees are going to go up. When you're not relying on advice, that fee should actually come down. And so that's the type of broker you want, is the broker that can just execute the trade and charges you a small amount of commission to do that. Initial margin or bond requirement is a small portion that you have to put up for the contract. It's required by the exchanges as a bond. It usually is about 5% of the contract, total value of the contract. It's a good faith deposit. Purpose is to guarantee the financial performance. Both parties, the long and short, have to put up that margin requirement. But the trader who is losing on paper, is responsible for maintaining 100% of his or her paper losses. Let's go through a quick example with soybeans. So in the soybean example, we're saying that the hedger, the farmer, is selling November beans. This is real life example at, let's say, $9.30 per bushel. And the initial margin is about $3,500 per contract, okay? So $9.30 per bushel, we're gonna sell, we're short. Remember, the hedger, the farmer, is long a commodity. So if, he has to do the opposite, equal and opposite in that futures contract. So in this case, he's selling soybean futures because he's long the physical commodity. 10 days later, the price increases by 50 cents per bushel. We go to $14.30 per bushel. Additional margin is required. It's 50 cents times the 5,000. Remember, the trading value or unit value times the number of contracts. In this case, it works out to about $2,500. So that farmer needs to bring that original margin back up to $3,500 per contract. For the trader who is long, not short, long, the original margin was also $3,500, but he or she does not have to put any additional money up as long as the price doesn't fall below $13.80 per bushel. $13.80 per bushel. Okay, let's have a quick example with wheat. A hedger farmer is also, maybe they grow corn, beans, wheat. Let's say that they're growing some wheat. Need to hedge that wheat. They're selling December Chicago wheat futures at about $9.30 a bushel. With initial margin of $2,500. 10 days later, price increases by US 10 cents per bushel. The margin in this case would be 10 cents times the 5,000, or an additional 500 to bring that original margin back to 2,500. I think you're slowly getting the gist of this. For the trader who is long, the original margin was also 2,500, but no additional margin is put up unless the price falls below that 9.30 per bushel level. Okay, so a farmer, again, who is long physical commodity, and he may be long corn, canola, beans, wheat, will need to open up a commodity trading account. We spoke about this in last week's video. This account is also known as a hedge account, not a spec account. You're not going to be long the market ever because you're already long a physical commodity. So, never long a speculative account. If you want to speculate, treat the accounts as a separate account. The farmer needs to prove to that brokerage house what they're going to hedge throughout that year. They're going to have to prove what they're growing and what they plan on hedging over the course of a year. The farmer will never go long futures unless he or she, because if they do, then they're double long. This would be twice the risk. So you don't want to go down that road. We're trying to reduce risk, we're trying to reduce volatility and manage that risk. So there's a bunch of financial institutions that can help you open up a commodity trading account. We're not here to favor one over the other. There's MF Global, there's RBC Dominion Securities, there's Freeburg Mercantile Group, Scotiabank, RJ O'Brien, Refco, Union Securities. Give them a call, Google them, find a number in your local area, and just compare the fees. Remember, the broker is there to help you execute your plan, your marketing hedging plan, for a very low cost. The role of that commodity broker should be limited to understanding your hedge or your marketing plan, be filling orders promptly. That's important. Make sure you always call them back because they're so busy they might not call you back on that order. And then providing you with accurate and timely position records and statements, monthly statements. They can either be mailed to you or emailed to you. Many so-called experts, financial advisors, commodity trading advisors, usually get the direction of markets wrong most of the time. So please do not rely on them for advice. You're only going to rely on them to execute that trade. So in summary, knowing the fees, the obligations, the margins can assist a farmer and prevent them from experiencing any future surprises. Remember, futures should be used only to hedge, not to speculate. Once a farmer has sold that physical commodity, delivered and shipped that commodity in the cash market, only then can a farmer buy back that short position and actually treat it as a true hedge. Otherwise, you're speculating. In our next video series, we're going to look at the advantages and disadvantages of hedging with futures versus a fixed forward contract that we discussed in detail in an earlier video. Thanks so much for joining us today. We hope we've provided you some insight and some understanding on financial obligations, margins, fees, and how to choose a commodity broker. Till next time, thanks for watching. Take care.